When an asset is liquid and publicly traded, we know its value minute by minute. When an asset is sold, we know its value as of the transaction date because someone wrote a check to buy it. How would you value an asset that is not publicly traded nor recently sold? Lately, there have been talks by Janet Yellen and the administration of taxing the rich and having them pay for the $6 trillion deficit caused by the pandemic. Hi, I'm Bharat Kanodia. I have valued large companies like Uber, Airbnb, and unique assets like the Atlanta airport. I tell owners what their companies are worth. Let's break down this new proposed tax legislation piece by piece and see the forest for the trees. 1. This new proposal only applies to individuals with net worth greater than $1 billion or annual income over $100 million over 3 years, affecting 700 Americans out of 330 million. 2. It would collect $200 billion in tax revenue over 10 years, or $20 billion a year. Annual tax collected by U.S. government is $3.3 trillion. 3. Tax will apply on liquid assets that appreciate in value, including stocks, bonds, real estate, bullion, crypto, and art. Generally, capital gains apply to the appreciated portion of sold assets. However, this law would levy taxes on unrealized gains. For example, if someone purchased, say, $200 worth of Bitcoin, which is now valued at $100 million, even if they have not sold any Bitcoin, they will be asked to pay capital gain tax on the difference between $100 million and $200, taxing paper profits. Here is why this new law makes sense. 1. 700 of the richest Americans use a strategy called buy, borrow, and die. They buy an asset, it appreciates in value. They take a loan against it. They get a tax write-off on the loan. And when they die, they pass along the wealth to their descendants who inherit that wealth without paying capital gains on the appreciated value. 2. U.S. citizens are supporting the growth in valuations of public corporations by buying their goods and services. Why should the government not tax the owners of such corporations for the increased wealth that is built on the backs of Americans? 3. Your government needs the money. They can't tax the poor and the middle class any more than they already have. And the top 0.0002% have enough to share the spoils. What is wrong by asking them to pay more? Counter-arguments against the tax legislation. 1. The proposed legislation levies $200 billion in taxes over 10 years, which is only 3% of the $6 trillion deficit caused by the pandemic. Why do it at all? 2. Give an inch, they take a mile. This tax will eventually be applicable to everyone. How income tax was temporarily levied in 1862 for the first time to pay for the Civil War and affected only 10% of the population. Income tax became permanent in 1914, starting out at 1% and designed only to tax millionaires. And we all know how, over the last 100 years, taxes collectively grew to over 50%, including federal, state, sales, property, and capital gains. 3. Valuation is a moving target. Say Tesla is trading at $1,000 a share, and Elon decides to sell 10% of his stake. You think Tesla will continue to trade at $1,000 a share? No. At the slight mention of Elon cashing out, the market will panic. This creates a valuation problem. The top 700 for whom this law is originally designed will do 3 things to avoid paying Uncle Sam. 1. Use their ammunition against them. They will use tax loopholes, including trusts, foundations, charities, to transfer wealth to family and enjoy tax deductions. 2. Become an expat. Tax havens like Puerto Rico protect against U.S. capital gains. Or take citizenship in Malta, Luxembourg, St. Kitts. 3. Don't IPO. There are other ways to raise capital and hide assets. Go public outside U.S. Create special ownership structures using private shell companies. Between you and I, this new proposal will be great for my business because it will mandate an annual valuation for every American, creating an exponential demand for my services. Thanks for watching.